Good evening, traders. Trader Geek Sam here with your Sunday, March 22nd, 2026 market review and preview video. Hope you're having a great weekend. And we'll start it off as usual, taking a look at the major performance by so many markets. And given that we had an options expiration triple witching on Friday, it was a little bit funky on Friday, too weak. We're looking at Friday's action on the major markets. The only thing in the green here is 11.31%. The VIX was up big time. Dollar was up just 36 basis points. But everything else losing ground, the strongest of them being Bitcoin, and the worst of them, gold, losing 3%. We'll see that didn't do too well last week. Micro caps losing the most in terms of equities, 2.5%. Mid caps down 2.5%, and small caps down 2.2%. Magnificent Seven, not so magnificent these days, down about 2%. TLT long bonds as yields are continuing to creep up, almost down 2%. So pretty much a red day across the board, except if you were volatility. Major markets for the week. High yield bonds, surprisingly, the best performer, although everything here has a negative sign in front of it. Aggregate bonds down 0.5%, and the dollar losing 0.75%, despite recent strength in there. Gold 10% down on the week. Big time drop for the IAU, GLD, gold futures, what have you. Microcaps down 2.7, Mag 7 2.6, the Dow losing 2.26%. That one, as once the Dow hit 50,000, it kissed it and must have been a kiss goodbye. SPY down 2% on the week, and Q's also down almost 2%. If you're in the VTI, the Vanguard Total Market Index, down 1.75%. We have one more week to go and 1 day to trade. So we've got 6 trading days left in the month and the quarter. The VIX is the strongest, up 35% since. Actually, this is the month, I should say. So this is the month we're looking at, 35%. Bitcoin, despite recent weakness and mixed strength, up 7%. Dollar up 2.2%. High yield bonds surprisingly holding in pretty well, only down 2.23% compared to gold, down 14.5% on the month. So that big bounce we saw in February and early March is pretty much gone. Mid caps down 8%, micro caps down 7.35%. So all the strength also that we saw in the small caps, micro caps, and the mid caps slowly dissipating. We'll see the year to date in a second. Dow down 7, TLT losing 5.5%. So we dropped out of that 90 range on the TLT. SPY down 5.5%, and same with the Vanguard Total Market Index. Quarterly basis, year to date, both the same. We're in the first quarter. Big winner, volatility. And who didn't predict volatility in a mid cycle election, or midterm election, he tried to say. Gold up still despite the recent weakness, up 4.35%, and dollar up 2.4%. Mid caps still holding on close to the zero line, though nothing year to date on the major markets is up. We don't have oil in here. I probably should. And the worst of them, 20% down, in another bear market for Bitcoin, down 20%. Magnificent Seven down 11.5%. And the Q's down 5%, Dow down 5%, and the SPY down 5%. So overall, we've got a 5% down market going into the last 6 trading days of the year. Before I move on to the sectors, just briefly mention futures are open, and the S&P futures gap down about 55 points, and now They're only down about 14. They fought their way almost to break even. Looked like they were going to turn green. In fact, they might have turned green for a brief moment. Oil opened up a couple of bucks and now has lost that $2 gain on some Trump tweet over the weekend about uh, threatening to have the Straits of Hormuz reopened or else. Um, and we've got bonds also down, as well as gold, but recovering. So gold's down about 66 bucks at the moment, but it was a lot worse earlier, down on about 116 at one point, and same with silver. So nothing is a safe haven unless you're the black gold, as they say about oil. But very nice recovery from a big gap down at the open. And this market is definitely oversold and looking to rally. And this is a good spot, as we'll see in a moment, for the market to rally. Looking at the sectors on Friday, nothing good here. Although the financials did eke out 0.18, showing some relative strength, but they led the downside, getting to where we are today. So they were kind of presaging all of what was happening in the market today. So seeing them bounce first is a good sign. It's a nice sign, but it's just one data point, and we need to see other strength from other sectors. XLE even couldn't hold on to its gains on Friday, and XLC Communications losing 0.8. Those are the strongest. And Staples, very disappointing after flirting with a 90 level, not showing any relative strength in light of a down market defensives. Here's another one, XLV. Wasn't showing any strength, even though we had a big down day on Friday, and transport's losing 1%. Worst of them were the utilities. Again, another defensive sector, but this one has been strong of late, kind of trading like energy. XME, metals and mining, of course, down with gold and silver, and real estate down 3%. On the week, energy and financials, the only two positive sectors on the week. Telecommunications just flat, and so was transports. Technology losing 1%, and retailer stocks down 1.7. XLI losing 1.8%, and XLC being the communications down 2%. Worst of them, metals and mining, giving back a lot of the gains on the year, and so were utilities and the materials and staples, real estate, and there you go, the healthcare. XLE leader year to date, 33%. Did I skip over the month so far for? Yeah, I did skip over the sectors for the month. So XLE up 6%. Everything else in the red, with the worst of them, metals and mining and materials, transports and staples, retailer stocks, healthcare. IYZ, the only one that's even close to um, uh, being up, which is down 1.8%. So a lot of red so far. March has not been friendly. The seasonality, both at the beginning and the middle, has not materialized. Now is the time for us to see some recovery from this weakness. Coming up on now, this is the year to date. XLE up 33% on the year after a nice ending to last year. Telecommunication stocks up 15. So strange to see telecommunications and energy stocks up at the same time. Staples still up on the year, and so are utilities and the industrials. Materials up 3.5, and the worst of them, financials, as we can see here. These have been the worst, and so to see them start recovering is a good sign, and just kind of a green shoot, if you will. The consumer discretionary almost down 10%, retailer stocks 8. and we've got the healthcare down 6%. So kind of half and half on a year-to-date basis. So it hasn't been a washout by any means. So we see rotation after rotation. Friday was the first day in a long time where we might have seen some degree of capitulation, although you really can't say that based on what was happening. And, that last hour recovery based on a tweet that we're almost done executing our mission brought back the markets from basically a waterfall decline in the afternoon. We'll see what happens. We're definitely oversold and in overdue for a bounce, but just because we're oversold doesn't mean we can't get oversolder. Yes, I know that's not a word. XOP, looking at major industries for the week, naturally up 5.5%. The next closest is solar stocks down 42 basis points. SMH losing a mere 0.2%. That's the chips, semiconductors, PEJ, entertainment, internet stocks. So when you look at them on a 1 week basis, not too bad. But here's the GDX, which was at, I think he got up to 110 now, has lost almost a third of its value since it peaked out a few weeks ago. 14%. KWeb, Chinese stocks, tech stocks down 6.4. Oh, looky, the pot stocks are down. Who knew? ITB, home builders looking not so great. ITA, even the defense stocks were down last week despite the ongoing war. And robotics down 2.45. Looking at the month on an industry basis, surprising. Exploration production up 15%. Cyber stocks showing a little bit of strength. You would think in this geopolitical environment, cyber stocks would be flying, but it's been a mixed bag. TAN, the solar stocks eking out about 0.25%, but look at GDX. I guess we got up to 115, 116, down 30% on the month, and ITB home builders looking 18%. Robotics 13, KWeb, Chinese tech, no bueno. ITA, the defense stocks losing 8.68%. So, buy the rumor, sell the news is once again alive and well when it comes to the defense stocks. You don't buy after the onset of war. You don't buy these stocks because they're already priced in, and somebody always knows something. And when they're heading up, you don't want to be the bag holder. Entertainment stocks, pot stocks, and the biotechs right there. All right. 5% down on the semiconductors. Taking a look at the quarter and year to date, look at XOP, exploration and production, 40%. The TAN, 12.28%. Those are the solar stocks, perhaps as an oil substitute. SMH still doing pretty good, up 7% year to date for the semiconductors, and ITA up a mere 4%. You would think that would be up a lot more. These are the defense stocks, and the biotechs just can't find an uptrend, 1.33%. At the bottom of the list, to no one's surprise, the pot stocks, then software stocks, and Chinese internet stocks. There's the FDN. Those are the American internet stocks and cyber stocks, down 10% year to date. Who would have thunk that? Blockchain stocks down 9.56%, and ITB, there you go, 8.34%. Taking a look at the Mag 7, we know what they look like. Every single one of them in the red. And surprisingly, last week, Apple was the strongest, down less than 1%, with Google right behind it. But Tesla really losing altitude, down 6%. NVIDIA losing about 4% after showing some relative strength the week prior. And Microsoft can't seem to hurdle that 400 level, kind of firm resistance there. Meta also losing about 3%. For the month, all red, guys. Tesla, Meta, Apple, the worst. Amazon, the best of the bunch, being up down only 2.2% quarterly basis. And year to date, Microsoft, the worst. Tesla, second worst. And then Amazon, 11%. The best of the best is Google, down 4.78%, but definitely not the quarter for Magnificent Seven, and they weren't exactly stellar in the fourth quarter of 2025. So that there you have it, kind of the look here, but courtesy of Kirk's Opportunity, wanted to show you some of the top tens here done by Charles Kirk. These are some of the top 10 winners and losers, either excluding stocks or excluding leveraged ETFs, and then everything. So if you were short the FANG index, you were up 9% last week. And if you were long silver, you were down 15%, gold minus 14%. Sugar, not sure what's going on there, but that one looking like a nice chart. Gasoline, no surprise. Energy, and if you're short anything, those are good, and nothing really else. You can kind of see the theme. Bad precious metals and industrial metals, good energy, and some of the sweet stuff. Not much else to see here. Surprising XRP. That is no, that's XRP is not the retailers. Can't think of what it is. Israel up 1.29%. Ethereum up 1.32%. So not too bad. Little green shoots there. But in any case, those are a little bit of highlights and lowlights for last week. Let's take a look at what's happening with the charts. And as we do every week, I have a tri-pane of a daily, weekly, and monthly chart. And we'll start with the daily chart. And you can see I have my two major stop levels here, a bearish chandelier here, a bearish PSAR. Chandelier is a volatility stop. It changes based on volatility level. And PSAR is more of a momentum parabolic stop and reverse stop. Both of them are in a bearish mode, so they're not telling us anything. Obviously, we undercut the 200-day on Thursday, tried to recover over it, and was not to be. And Friday, ugly stick, but a nice recovery at the end of the day on some news. You can see here, MACD is definitely on a sell signal below the zero line. No turn up yet in the fast line. We are in the oversold area down to the 30 level. So we don't have yet a higher low to speak of on the index because we need a bounce first. And we definitely don't have momentum divergence, because the last low here, we've undercut that in terms of the relative strength index. One of the things we undercut on Friday, the November low, so we took out that target, and then we had the 23.6 fib target taken out and close right above it. So we ought to see a confluence of support in this area. And you can see down here for the week, we have our options implied expected move, and that's come down since last week, which is kind of surprising in light of all the volatility. Last week's expected move was 212 points, give or take. And that's either up 212 points or down 212 points. And once again, we did not touch the or traverse the upper edge or the bottom edge of the expected move. And this makes 10 weeks in a row where we've stayed inside the options implied expected move. And that's a pretty efficient market. And if there's a negative there, it's that we're overdue to kind of pierce the options implied expected move. My guess is it's going to probably be to the upside given the weakness that we've seen from 7,000 all the way to 6,500. So that's, a good 500 points that we've traveled. But here's where the lower edge of the expected move is 6,300. And if we don't hold the support area, our next target is down here at 6060, a full almost 7% down to this level. So we've got to see some support. And my inkling is that we will see a bounce, but I don't think it is the end of this decline. I think we need to do some sideways consolidation. We need to see some stabilization here before we can start attacking higher highs. But could this have been a bear trap? Certainly could be, but we have to see it in the price action. But for now, we're hoping this confluence of support holds and we can get a robust bounce into these oversold conditions. And certainly the overnight markets futures are not showing weakness, relatively speaking, to where we opened up. So that's a good sign for Monday. Switching over to the weekly chart, we have a bearish chandelier, which just flipped last week. We tripped it up. Here's this chandelier line, this green dotted line. We violated that on a closing basis for the week. So we have a bearish chandelier. We have a bearish parabolic stop and reverse. We'd have to come up to 69.56 to flip that on the weekly. On the daily, we just need a close above 67.62 to flip that trend indicator on the PSAR. If we want to get above the chandelier stop, we have to get above 68.54 to flip that back to positive. Or maybe it's right there, 67.74. In any case, back to the weekly, been on a sell signal since, call it November. And we did make, despite that, we still made new marginal highs up to the 7,000. And this blue line here is the 50-week moving average, simple moving average. So that could constitute a bounce point in some systems, and some traders pay attention to that. We have this yellow line, which is the 8 crossing below the 21 EMA. So that's not a good sign on the weekly, but we already knew that because the chandelier flipped bearish. And unless we flip it back pretty soon, this is portends a little bit more weakness in the markets on a weekly basis. So hopefully this 50-week moving average will offer some support, and we'll get something more than a silly bounce that sucks in more bulls and we head lower. A lot of news driven, a lot of chop, a lot of action that's just strong in both ways, but nobody can really accomplish anything. But so far, the bears are winning. Moving to the monthly, we still have a bullish chandelier and a bullish PSAR. We'd have to get below 61.41 to trip that PSAR, and our where's our chandelier stop is right here, right around the same area, actually, about 61.01. We got to close it on a monthly basis. We're far from it. We're still in an uptrend on the monthly, though we are now below the November low. That can be easily corrected. The month isn't over. We have 6 trading days to go. And so if we trade or close above 65.22, we will have violated the November low, but not close below it. And the low in October was 65.50. So we clearly want to try to close above 65.50 to keep this bullish consolidation alive and well. We certainly don't want to close any lower than where we are. This is the 10-month average. My drawing, or is that that's not what we want. Get out of my way. Let's see here. Not trying to. Yeah, 10-month moving average. So that's a critical line for us. If we can close above the 10 MA on the monthly, because in some systems, the 10 monthly moving average is a sell signal. And we certainly want to close above, call it 6,600 for the month. You can see the MACD is starting to flip negative here. And we're definitely out of the overbought area down to 62. But we did have a great run here for a while. So call this neutral to bullish. I'll call this bearish, and this is definitely bearish. So the bears have the ball, and it's theirs to lose at this point. So the bulls have ceded their advantage. Switching to the NDX, bearish chandelier, bearish PSAR on the daily, and we have a downtrend line, and we can just extend this this line over here, and we've got to get above there to see a change in trend under the 200-day and getting under the 24,000 level. Not a good thing. And again, this also had a bounce and looking a lot stronger tonight after losing about 200 points at the open. MACD is definitely on a sell signal, looking bearish under the zero line. And we're not as quite oversold as the SPX is. We're down to 35 RSI here. So definite advantage to the bears. And you can see here that the top of our options applied expected move here is not too far, 24,643. So our expected move for the week is about 745 points plus or minus. And here's the lower edge of the options implied expected move down here at 23.2. So we'll see which way it goes. My guess is we're going to end up closer to the upper edge than the lower edge, given how oversold we are. And there does seem to be some appetite to pick up some stuff at these level, but obviously news trumps everything. No pun intended. Bearish chandelier, which flipped last week, again took out this line in the sand here. That is a volatility stop, and that's no joke. I mean, these volatility stops are on my screen for a reason. When I see those violated, I get more cautious, especially with any of the NASDAQ stocks. PSAR has been negative for a while. We're in a downtrend. We need to see this downtrend line taken out. MACD has been on a sell signal, getting oversold on the weekly, but not quite there, only at 42. So nothing to speak of there. And again, you can see the blue line here, the 50 SMA line could prove to be a bounce point if we see further weakness. And then here's the monthly chart, bullish chandelier, PSAR still looking good, consolidating, sideways action. We are below the 10-month moving average, MACD looking to flip down, and we're definitely out of the overbought area on the RSI. So call this neutral to bullish, bearish, and definitely bearish. So once again, bears have the advantage here. It's the bulls have ceded their leadership here, and they need to take back control, and that's going to take some time and effort before we see that happen. So this is a chart of the Russell 2000, the last of the majors that I look at. There's a downtrend line, and now we have a new one down this way. So a lot of moving averages, but here we are. We're just bouncing off the 200-day here, and this purple line is the lower Bollinger Band. So we're not as We're not under the 200-day, believe it or not, on the Russell, but this was still showing more relative strength in January than the other two were, but certainly has given up the ghost. You see a MACD that's definitely negative below the zero line, and we're getting oversold on the RSI down to a 33 level. So again, portending some type of bounce. On the Russell 2000, we have about 95 point expected move. There's the upper edge, there's the lower edge. And again, my guess is that we end up somewhere closer to the upper edge, if not exceeding it, if we get one of those coveted rip your face off rallies. And that could happen with some good news or change in tone about the war. Definitely not just the war that's affecting things. Hotter than normal inflation. One of the worst new housing reports that I've seen in a long, long time. And, jobs reports are basically holding up okay. And we even had some good PMI reports. So economic news is mixed to positive, but we're definitely hot on inflation. And so the FOMC all but closed the door on maybe one rate cut for this year. So Wall Street doesn't have much to look forward to in terms of rate adjustments, especially in light of inflation and the unknown effects, long-term effects, and how long this energy pricing will remain elevated and cause what it will do to future inflation numbers. Bearish chandelier, bearish PSAR on RUT, has been there for a while. We took out that chandelier a couple of weeks ago. We are a little bit farther from the 50-week moving average, but definitely in a downtrend on the weekly. And then looking at the monthly chart, despite a great start to the year, we have a nice, I shouldn't call it, this is a pretty hefty red candle, but it is holding the 10 simple moving average on a 10 monthly. So we don't like to see closes under the 10 monthly moving averages because they tend to portend bad things. And you can see what happened here. We came down and went down another month, ended up coming back, but still, once you close under there are some systems that basically automatically sell on that. MACD, still, the fast line has not crossed over the signal line, still above the zero line. Monthly is positive, and we have an RSI 56 on the monthly. So what do we have here? We have, call it neutral to maybe bullish on the monthly. Definitely bearish on the weekly and bearish on the daily. So bears have the advantage here. It's theirs to lose. So, in some respects, this looks better than the other indices. In other respects, we're just not seeing small cap strength that's durable. We're not there yet. And even the micro caps, which were strong last year, and the mid caps, which were strong earlier this year, have lost a lot of relative strength. And, it's not just the US. I mean, this is worldwide. So, here's the VEU conglomeration of developed and emerging markets. I don't usually look at this on this video, but you can see here from 82 down to 72. So this is a lot of overseas companies, but they've lost altitude. Call from 82 to 72, call it a little bit over 10%, and maybe 12%, 82 to 72. And you can see on the weekly, just been straight down. And what was a safe haven and outperformance, overseas markets have not really been cutting it. And here you can see the March candle taking out the February, January, and now the December candle, giving back 3 months in just 1 month. So I was thinking that the overseas markets were going to start carrying the baton for the world, but so far that's not holding up. VIX on last week, basically closing below the prior week close. So despite all the volatility and the loss in altitude in the indices, the VIX continues to stay a little bit suppressed. So the week before we closed at 27, and last week we closed at 26.78. I mean, it's a rounding difference, if you will, but it's just amazing to me that with all this volatility, we just can't hold the thing. You can see volatility on Friday got up to the 29 level, and overnight here we're up about 4% in the volatility futures. But my guess is if strength remains in the indices, that will turn red as well. But in any case, we are far above the 200-day on the VIX, and what we need to see is two closes below the 200-day to signal the all clear on the volatility and the bulls taking the advantage. So that's all the way down here on 17.75. We're not going to see that that quickly, but stranger things have happened. Taking a look at this close cousins of EVIX, this is the volatility of the volatility, a measure of institutional VIX call buying. We're at the 126 level, and this is far above the 110. So keep your seatbelt on. This is not over yet in terms of volatility. And until we see this under 110 and preferably under 100, this is nothing to be messed around with. We're going to see volatility in both directions. It doesn't mean you can't get a rip your face off rally, but it also means that this is still a warning sign that volatility has not left the building, as if I need to tell you that. Let's take a look at what the pricing on the VIX options were. And they were telling a story on Thursday. And what I like to do for the new viewers and listeners is look at the VIX option pricing. And this is one data point that I like to point to. And if we take a look at we were at 26.78. Let's round it to 27. And if I were a buyer of the one strike out of the money, and I go to the monthly expiration about 23 days out, that's the next monthly expiration, and for the VIX options as well as the next VIX futures contract, you can see that the 28 calls, if I were to buy them. So if I'm bearish on the market, I'm buying calls on the VIX, right? So we are at $2.63 for the VIX calls. If we're bearish on the VIX and bullish on the market, we are going to buy the puts. And if I'm at 27, I'm going to buy the 26 puts. And look what we have here. We have an edge on the puts over the calls. So they're pricing at 385 versus, call it 273. So the puts are slightly more expensive than the calls. And sometimes when you get a durable bottom in the market, you can see that the puts are priced at 3, 4, 5, even 10 times the calls. And that's when you know that they're really hedging their VIX exposure and looking to benefit from upside in the market. So one data point, it's a feather in the cap of the bulls, but it's not a big one. When it's this close, you usually still see some choppiness and flip-flopping. But it is nice to see, at least at the moment, that puts our pricing in more than the calls. And the other thing I like to look at is the VIX future structure. And for weeks now, we have been in a backwardation. So as you would expect, VIX futures contracts, the farther you go out, you would expect volatility to be higher. But that's not the case right now. We've got May contract at 24.85. June is a little bit less. July is a little bit less. And August is a little bit less. And the front month April contract is at 26, but the spot VIX closed at 26.78. And this is even after a 95 cent increase on the futures overnight. So we are still in a backwardation market where the risk is at the front month and at the spot VIX, which means that the risk is here and now. And this is another thing we need to see reverse, where the VIX, spot VIX, is cheaper than the outlying contracts. Reverse this backwardation back into contango, and then we can start saying that we have some type of rally more than a couple hours or what have you. Taking a look here, you can see if my marks are still good. So March 27th, after a wild Friday with a triple witching expiration, yeah, we've got a $188 move coming plus or minus for this week. So I'm surprised that it went down, but I guess that makes sense since the VIX was down. It wasn't really up on the week. Blows my mind given everything we're seeing, but hey, it is what it is. And 188 points is nothing to sneeze at. We could move that much in a single day, and on just on news events and what have you. Speaking of news events, take a look at this week's economic reports. You can see that it's a fairly light week from major economic reports. Construction spending for January, big whoop. I mean, it's 2 months old. And then Tuesday, productivity, flash PMI, services and manufacturing for March already. Some Fed heads talking, import prices, nothing really on Wednesday. Thursday, our typical jobless claims, and a whole bunch of Fed heads talking, I guess, after last week's FOMC meeting. They're out in full force yakking it up. And Friday, we have consumer sentiment. So not a really busy or newsworthy week. So that you could say goes a little bit hand in hand with the lower expected move for the week. Finally, we have the wind down of this quarterly earnings season, and there's not much really to point to coming up this week. Most of the majors have recorded. It's been a great earnings season, but Ondas has received a lot of attention due to the war. Chewy, as one knows, Cintas and Paychex coming up, and we also have Beyond Meat. It's still a company, eh? All right, so nothing really. Lucid Motors, big deal, but nothing. Carnival Cruise Lines on Friday, but pretty much any company that's really significant to the market has reported. So in any case, that's what we have for earnings and for economic reports on the week. But switching back over to the weekly, I mean, this is a prove it market. I mean, do we have a bear trap and we head up? Probably. My guess is that any bounce is going to meet a lot of stiff resistance, and whatever bottom we have here probably won't be the bottom. Whether we get down to this double top reversal target at 60.60 remains to be seen. But in any case, we could be in the soup through the end of March and through April. And a lot of times, given that tax payments are due April 15th, we usually don't start seeing signs of strength until after April 15th. But who knows? That's just speculating out to the future. But my guess is any bounce we're going to get is going to be looked at as a lower high, and we wait for that to see if we get a higher low, and then we can see the start of any kind of uptrend. But what we want to see is the price action proving what's happening here, and before we make any decisions. Meanwhile, you got to be flexible. You got to be taking profits as you have them. As I always say, if you don't take your profits, the market will take them for you and not even give you a thank you. So be careful out there. It's choppy, it's messy, and don't put too much on the line until we have reliable signs of a reversal and signs that price action is proving that it's worthy of your capital. With that said, I hope you have a great trading week. I appreciate you tuning in. Tell anybody and everybody about it. At Trader Geek on Twitter is my handle. And I will see you probably not next week for tax season. We'll see if I can get a video out. I'm in the thick of tax season, but I certainly will try. And in any case, I will be back after April 15th with these videos. If I'm not able next week, I definitely won't be able to do it after the following week. But I do appreciate you tuning in, and I will see you next time. Have a great trading week. I'll talk to you next time. Bye-bye.